right, let's talk about internal rate of return versus annual rate of return on a life insurance policy. A very difficult thing to understand and yet totally provable. So, the first thing that we're going to do is acknowledge that we are on the tools, life insurance values. We have copied and pasted the premium for a 14,920 base, 12,000 PUA, so approximately 50-50. Please don't get all caught up in whether it's max PUA or not. It's close enough. And we've copied and pasted the cash value and the net death benefit. And as you can see here, there's an total IRR column that is internal rate of return. This column you can actually get from your life insurance company and put it on your illustrations. I would not do that. It is an extremely confusing column. What you also see here that you cannot get from your life insurance company is annual ROR. This is the annual rate of return on the net cash value, and you can see what's going on here. I'll come to more detail in a minute on these, but we can also obviously identify the total IRR on the net death benefit. So, first thing that we want to do is acknowledge that with the annual ROR, we can start to see positive cash flow returns around the 6th year. For some policies, it's going to be 3 or 4, others it might be 6 or 7, but within that time frame, you can see positive cash flow, meaning what we have put in that single year, plus what is already in there is gaining a positive return in that individual year. And we can see if we go down here to the 25th or the 30th year, which is really where we should be looking at life insurance, we can see the annual rate of return, for example, let's just use the 25th year, is 4.7%. 4.7 is our annual rate of return on that individual year. I'll prove those numbers in a minute. We can see also that the internal rate of return is 3.64 in that individual year. Well, what's going on there? Well, the internal rate of return carries all the baggage from these negative years. However, it is very, very important to not say that you do not get a positive return until this time frame, 11th, 12th year, whatever this is, because in order for the internal rate of return to be at 3.64, you have to have earned 3.64 every single year in order to get that. Let's take a look. So I have also a rate calculator that we'll put on top. And what we're going to do is identify this 3.64 as our internal rate of return and prove it. Well, how did we get there? We got there by taking $27,000 every single year and earning the 3.64 and having the 1,118,254. Let's prove it out. So we're going to look at this rate calculator, and it's very important because life insurance premiums go at the beginning of the year, and the calculator's default now to end, at least mine is, based on maybe what I've done recently. So you'll want to be conscious that you've got yours at the beginning. Okay, the first thing that we're going to look at is we've got this cash value of 1,118,000 in the 25th year, and we're going to prove this internal rate of return. So we want to copy this, and we know that that's our future value, and we know that we got there by putting in premiums of $27,184 at the beginning of every year for a period of 25 years. And that gets us a 3.64% internal rate of return. Let me say that again. We put in $27,000 every single year. We have 1,118,000 of cash value. We did that for 25 years. In order to have all of those numbers be true, we had to have an annual interest rate of 3.64. 3.64 is your 25th year number on your internal rate of return column. This is why this column is so confusing, and this is why we do not recommend that you put this column on your insurance illustrations. Furthermore, this life values tool is really designed to be behind the scenes. There are definitely some people that sell with it. I personally don't and wouldn't, although I will admit to you, I have shown it to a client, but only if I take the time to do this extra step. Otherwise, that just is not a clear number. Well, how on earth is this 3.64 happening with all these negatives? Well, it's very obvious right here in the annual rate of return. The policy is earning greater than the 3.64 in many, many, many years in order to overcome all of those negative cash flows in the early year. So let's prove out that column. So we're going to grab another rate calculator. It's already on top. It's already at beginning. And now we have a $27,000 payment still. Okay, I'm going to paste that in. And this is very, very important. I have from the previous year $1,040,040. It's not just the 27,000 that made this happen. It's the $1,040,040, and I added the 27, and my future value is the $1,118,000, and I did that over a single year. Well, that rate of return is 4.7%. The annual rate of return number at the 25th year for this policy, which is $1,040,040 plus the premium of 27 equals 118. In that single year, it earned 4.7%. Please take a picture of this with your phone, memorize this, do whatever you need to do. Even if you never show this to a client, it is imperative that you get it in your head to be clear on the difference between internal rate of return, which is a net number. It is after the cost of the death benefit. It is after the cost of running the mutual company. It is after the cost of our commissions. And of course, it is after tax. So for many, many people, that is a much higher number, which of course you can prove that out on the funding calculator. But our job today was just to get really clear on the difference between the internal rate of return, IRR, and the annual rate of return, ROR. Enjoy.